Welcome, everyone, to another episode of How to Make Money in Stocks. I know, Amy, you've been itching to tell a story about your trip to the outlets.
Yeah, well, I went to the outlet store, and of course, this is not cast in stone, but I observed something kind of interesting.
Okay.
There was a line to get in Michael Kors and a line to get in the Coach store. I mean, people were standing out in the heat waiting to get in these stores. But I looked inside the stores, and people were not purchasing. It was just kind of a cool, hip place to be. Look at the purses, look at
cool
the things.
Might be the key word.
It was,
they
were yeah, maybe they went in to get in the air conditioning.
Right.
I don't know. But then I went into the Nike store and the Under Armour store.
Right.
They were so packed you could hardly move, Matt. I mean, just packed. But that wasn't really the key thing. The key thing was people were at the cashiers. I mean, there were lines to buy stuff. They had one upstairs and one downstairs. It was packed. So when you're thinking about supply and demand, you go into a store. It doesn't matter how many people are in there, how many people are buying. It's just and of course, Nike and Under Armour are two stocks that are doing pretty well. Or they're holding up well in the current market.
Yeah, there are times in the retail, especially when it's doing really well, that you feel like you're walking around inside the IBD 50.
Yeah,
all the
it's
stores
so
that are on the list
or in the
sitting
mall.
right there
They
in
are.
the right kind of market.
They are.
Now, this week, what we're going to talk about is how to handle follow-through days and how to separate ones that look like they're going to work versus ones that are more likely to fail. And we want to let you know that because, Amy, you're going to be on the road going to Las Vegas, we're recording this show a little earlier than usual. As we just mentioned, Amy is in Las Vegas this weekend, so we recorded the rest of the show on Thursday. But this market segment is based on Friday's close. And it was, again, an interesting but challenging week for investors. We saw a new uptrend begin, but the very next day, it came under pressure. Here's what that looked like on the NASDAQ. The tech-heavy index established a new bottom on August 24th. And from there, we look for a follow-through day to signal the start of a new uptrend. And we'll get into that in more detail later in the show. But we did get a follow-through day on Tuesday, September 8th. The NASDAQ was up 2.73%, and volume was higher than the previous day. Unfortunately, the very next day, we saw a bearish reversal, with the indexes moving higher during the day, but closing in negative territory and near the bottom of the price range. When you get that type of distribution or institutional selling, right after a follow-through day, it often spells trouble for the budding rally. So over the course of just 2 days, the outlook shifted from market in correction to confirmed uptrend to uptrend under pressure. But as of Friday's close, the uptrend remained intact. Now, one thing to look for next week is the meeting of the Federal Reserve on Wednesday and Thursday. Most market watchers do not expect the Fed to announce a rate hike this month, but investors are looking for a little bit of clarity here, and whether they get it or not, or whether they like what they hear, is certainly an open question. Now, one stock of interest this week has been cybersecurity leader Palo Alto Networks. It reported earnings on Wednesday, September 9th, and beat estimates on both the top and bottom lines. Sales growth accelerated for the third straight quarter, and earnings growth jumped for the fourth straight report with a 155% gain. The stock shot higher the next day and closed the week up very nicely. Now next week, see if it can move more solidly above that 10-week moving average line and continue to work on the right side of that base. Now, these are not recommendations, but another stock to watch is Restoration Hardware. It still needs time, as you can see, to refurbish its chart, but the bounce it got this week following Thursday's earnings report certainly helped. The upscale home furnishings retailer topped estimates for both earnings and sales and said it expects its new concepts, RH Modern and RH Teen, to keep that mojo rising. Now, we don't have time to cover it here, but obviously Apple's slew of new product announcements generated a lot of attention. But you can find full coverage of that and also how the iPhone 6s and other new releases could impact chip stocks and other companies that are heavily tied to that Apple ecosystem. For that and more analysis of the market and stocks to watch, visit investors.com/investingshow.
Since we had a flash crash type of event in the market, we thought it might be interesting to go back to another period of time when the market had this type of selling to see what happened afterwards.
And here's what we saw recently on August 24th. The NASDAQ fell sharply during the day, but did manage to recoup some of those losses. that type of sudden but short-lived drop is often referred to as a flash crash, and it's largely driven by computer or program trading.
And then institutional investors realize that the sell-off was more pronounced than it should have been, so they will typically step in after a brutal sell-off and pick up shares at a lower price. But what happens here is it destroys the base patterns or the setups. Everything just looks very, very messy after a sell-off like that.
That's right. And as we noted earlier in the show, we did have a follow-through day on September 8th. Now, time will tell how that plays out, but let's go back to a May 2010 period when we had similar action in the indexes and see how that went.
All right, this is a daily chart of the NASDAQ. As Matt said, this is May the 6th, 2010, and we had a similar type of flash crash. Now, you can see by the wild swings, it looks very similar to what happened recently in the market. Now, note that after that, and we're not making any predictions here, but the market seesawed back and forth for a while before resuming a real uptrend. Again, it doesn't really mean that that's what will happen this time, but it may be a good indication that it will take a market a while to settle down.
Now, when the market is still in a correction, you're looking for that follow-through day to trigger a potential new uptrend. But as we've said multiple times now on the show, not every follow-through day works. So sometimes they do not lead to a sustained new climb. And a few did fail during that period right after the flash crash of 2010. And the first one was on June 2nd, where the NASDAQ closed up 2.6%. That's a nice gain.
Yeah, that is.
And as you can see, volume was higher than the day before, which is one of the key requirements of a follow-through day.
These are the head fakes we're talking about. Now you can see how choppy the market was, yo-yoing up and down. This is the market pulse from the big picture column, June the 2nd. The follow-through day that Matt referred to, June the 2nd, had some leaders up on volume from the big pick, but none of them were in bases or price consolidations. Matt and I went back and we looked at a lot of these stocks, and you need a lot of stocks that are setting up for a follow-through day to work. Stocks coming out of bases on big volume and continuing to move higher in the days after a follow-through day.
So for that June 2nd follow-through day, it did end up failing pretty quickly, and the market fell back into a correction. But then we had another follow-through day attempt on June 15th, just a couple of weeks later. The NASDAQ was up 2.7% this time, and volume was higher than the day before. But like on June 2nd, the volume was actually below average. Now, for a follow-through day, it does not have to be above average, just higher than the day before. But nonetheless, the stronger the volume,
the more powerful
on a follow-through day, the more powerful
absolutely.
And the more likely it is to succeed.
So the June 15th follow-through day failed, but then July the 7th, we had another follow-through day. And what happened with that one, Matt? It also failed. Once again, the leadership just wasn't there. But now finally, on September the 1st, we did have a follow-through day that worked out. And this led to a really nice uptrend that worked very, very well. There were stocks breaking out of chart patterns that went on to make some significant gains.
Now, of course, all of this can certainly test your patience, which is why you want to stay disciplined and focused on those signals and then what happens after we get that follow-through.
And you want to stay plugged in because you don't know when the market's going to just take off and go.
And at the time, we didn't know which one of those follow-through days was going to work, but we do know that they do trigger new uptrends, so you have to pay attention and get in. Now, one stock that broke out at the time, actually the very same day as the follow-through day, was Chipotle Mexican Grill. And that's not uncommon because stocks that go on to become the big leaders in the next uptrend typically break out right around the same time as the follow-through day.
Or within a couple of weeks or so.
Within a couple of weeks, or maybe even a little bit before. Now, during the correction, Chipotle had formed this cup with handle, and then it broke out again that same day, September 1st.
And it broke out on big volume, and it made a nice 70% gain before hitting a peak of 262.78, and then going on to form another base. So for follow-through days that work, we should have stocks like Chipotle breaking out and moving higher on some big volume. And the more breakouts that you see, the more health there is in the market.
And Chipotle certainly wasn't the only one breaking out around that time. Others like Tractor Supply and Netflix also formed bases during the correction, during that prior downturn, then launched new runs as the new market uptrend took hold.
All right, let's take a look at Tractor Supply. This was another one that did well from the follow-through day. It came out of a 72-day price consolidation and began moving up and finding some really nice support along that 50-day moving average line. It made a beautiful 80% move before hitting a peak of $65 and forming a flat base.
Now let's take a look at Netflix. It actually broke out of a double bottom on August 10th, so that was a couple of weeks before the September 1st follow-through day. And that can certainly happen, and it's really a sign of strength that this one is really picking up steam as the overall market also starts to get underway. Now, even if you didn't buy or you don't buy stocks like that because it's in a market correction but it broke out a little bit before a follow-through day occurred, a lot of these leaders are going to give you another chance to get in if you're watching them closely, and Netflix did that. It jumped off the 50-day line on heavy volume on, again, that September 1st follow-through day. And as I noted in my book, Netflix took off from there. It rose 150% from that pullback entry in just 11 months. So
those are some pretty nice gains.
Great gains, and it's just one reason why you want to study the behavior of past winners.
Right, because we're all in this to make some money.
That's right.
What it's all about, and history does help. So the point is, for a follow-through day to work, we have to have stocks like Netflix, Chipotle, and Tractor Supply breaking out and moving higher. And as Matt and I said in last week's show, we're likely to have some head fakes and perhaps some failed follow-through days before we get one that works. But that could always change, so remember to stay nimble and flexible.
Right. So let's take a quick break, and we'll come back and talk about another indicator, another couple of indicators that can help you separate between follow-through days that are likely to work and those that are more likely to fail.
How would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
Now, we've mentioned on the show multiple times that new uptrends begin with a follow-through day, but not all follow-through days work. And that's why you want to get in gradually after a follow-through day to see if it takes hold and the market and stocks gain traction. And it's also why you want to keep an eye on secondary indicators that can help you separate those stronger looking follow-throughs from weaker ones.
Now, we talked about looking for stocks that are moving higher out of price consolidations. So where can you find this information? Well, there's a lot of different places. One is the advanced decline line, which is in IBD every day. And another place is Stocks on the Move, both on investors.com and in the paper daily.
So let's start with Stocks on the Move. And if you look, this feature just lists stocks that jumped higher that day on unusually heavy volume. And just compare the list that happened on the follow-through day on June 2nd, 2010, which failed, and the list from the September 1st, 2010 follow-through day, which worked. Look at the length and the difference in the number of stocks that were on this list. that tells you that large investors were certainly more enthusiastic in September than they had been back in June.
And this is one of my favorite lists because you can really see what is moving higher in the market on heavy volume. And that really shows where the professionals are putting their money. On a successful follow-through day, you want to see a lot of names showing up on this screen. And that tells you that there is breadth in the market and it's not just a one-day wonder on some big news.
And we want to emphasize that the primary indicator is to look for that follow-through day on the indexes, on the NASDAQ or the S&P. But for that new rally to really take off, you do have to see these leading stocks setting up and starting to move. Otherwise, what are you going to buy? There's nothing to buy if they're not setting up and taking off. Now, another secondary indicator to watch is the advanced decline line.
Now, the NYSE Advanced Decline Line is in IBD every day, and it shows the number of stocks that are advancing versus the number that are declining. Now, again, this gives you a feel for stocks as a whole. You know, the Dow is only 30 stocks, but the NYSE is a lot broader group of stocks. In Bill's book, and this is Bill O'Neill, the chairman and the founder of IBD, he says that during corrections, you will have several rally attempts. But the advanced decline line may point to a market that is recovering versus a rally attempt that will fail.
And just below that line, you can also see the actual number of stocks that advanced versus those that declined that day. These are the numbers for Wednesday's action, which was the very first day after we had the follow-through day on Tuesday. So if you look at that, for every stock that moved up, about 3 moved down. And that is not what you want to see at the start of a new uptrend.
No, you don't. Now, you can get some head fakes because on the failed follow-through day from June the 2nd, 2010, there were a number of advancing versus declining stocks. In fact, there were almost as many as there were from the follow-through day that worked September the 1st. Now, the difference here is that most of these stocks were not in proper base patterns or price consolidations, so breakouts were not occurring. But September the 1st, 2010, there were stocks breaking out on some big volume. So we have to combine the advanced decline line with a little bit of chart reading.
And the bottom line is when a follow-through day occurs, you also want to look at how the leading stocks are behaving and check in on that advanced decline ratio. Also, what happens right after a follow-through day is incredibly important, and it'll tell you a lot about whether that new uptrend is more likely to succeed or fail.
So if you are new to IBD, we have a lot of videos that can help you out. So be sure to go to our website, which is investors.com/investingshow. And then we have a number of colleagues also that do some terrific videos. So be sure to check those out. They're just really, really good for learning.
Right. You'll find videos throughout the week. We have the Stock Market Today video, which comes out Monday through Friday, tells you what went on in the market that day and some stocks to keep an eye on. We also have the IBD Stock Analysis, which now, by the way, we changed the schedule. It comes out on Tuesdays and Thursdays now. And again, you'll find all that at investors.com/investingshow.